All right, so this is week 49 Outlook 2 of 2. I was off in my uh, calling the last one week 48, the earlier one. This is actually week 49. So this is week 49 Outlook 2 of 2. Let's go ahead and get into it. Starting with Euro USD, as expected, going out to the daily, we analyzed that price would continue pushing higher. Immediately, the target would have been this internal liquidity point here, which is a part of the pullback from the liquidity point, the external liquidity point at the high here of this overall price leg. So we got reiterating the price leg low, which is the structural point, impulse up to generate the liquidity point, and then once we break a significant liquidity point inside of the impulse phase, which is essentially the last higher low inside the impulse phase. Once we get that break of structure, that initiates the pullback, and now we have a price leg, right? And then once we have the impulse, we get the pullback. Now we have the price leg. We pulled back to mitigate the inefficiency that was generated during the impulse phase of the price leg, and then we get the secondary impulse. The secondary impulse is what we expect to continue the trend. So what I'm seeing right now is the continuation, or the, I guess, maturation of this, where we got the initial mitigation of 50% of the price gap that was left in the impulse here. And then once we got that response, this generated a price gap in itself, which we mitigated 100% of. And now we have begun to press higher. We've immediately mitigated this liquidity point here, and we would be expecting price to continue higher to take out these internal liquidity points with the hope, or with anticipation, that price will continue to take out the next high and generate the next portion of the price leg. If price were to do so, then what we would have is this be our structural point, because this is the low, or the lowest low, before breaking this high. But that's, like I said, that's extrapolation. Don't want to extrapolate too hard, but following the bias, this is the expected outcome. If this were to fail, then we would expect transition in order to break the external structural point, which we've discussed earlier. All right, so that's what we're looking at on EU. On GU, finally, we got some motion. I'm not in any trades right now for GU, but the analysis, if you've been following the market outlooks, you guys understand what I've been looking for the longest time, why I've been saying what I want to look for here. And just to TLDR it, we had we had the transition from bullish run to bullish range into a bearish run, and we're looking for solidification of the price leg, as in we have the initial impulse of the bearish run, and also the initial impulse that coincides with the initial impulse of this bearish price leg. And now we're looking for solidification of the bearish price leg, which would be mitigation of this high here, which just seems like that's what price is looking to do. And once we get that, then the pullback will be substantiated, it will be initiated, it will be solidified, all those terms. And then once we get that, I'd be looking for mitigation of the inefficiency that was generated during the impulse phase, which would be this price gap here. And then I would be looking for a trade off of this continuing price action to move lower. The counter trend is the fact that, hey, what if price just decides to forgo all this and continue higher? Well, then we'll have to reanalyze, and we'll have to look at that. But as of right now, based on the analysis, we have bullish run, bullish range, bearish run. We have the impulse phase of the bearish price leg generated. We're looking for solidification of the liquidity point, which will be based on the maturation of the pullback, which will be here if once we mitigate this liquidity point, and we have our structural point already solidified because that took out this structural point here. All right, so that's what we're looking on GU, and then continuation lower after we get the mitigation of inefficiency in the price leg. All right, on to the NASDAQ. Yeah, so like I said before, what we're looking at, we have the price leg. We discussed in the previous outlook the transition, or the shift in structural point of the low of this potential next price leg. We talked about the area of interest in this price gap that I was looking for. And we saw that, hey, there was also this price gap that price gave, sensitivity response to, but it failed ultimately because, overall any trades off of this will be counter trend to the overall market bias. So it's unlikely that that any response from these price gaps on the counter side, or really the pullback, I should say, but as of right now, the counter of the overall trend will yield any results going like really, really strong moves from the swing perspective, from the macro perspective. But if you're looking, to take these counter trend trades, there were definitely tons there. But overall, looking at it from the market outlook perspective, we're looking for a continuation of the bullish trend to take out this all-time high, which will be a part of the impulse phase of this price leg. And then once we get that, then we'll be looking for a pullback and so on and so forth, continuation and so on. But as of right now, what I'm looking for, like I discussed in the previous outlook, was mitigation of this price gap here. If it were to do so, it doesn't have to do it automatically, right? Because we are actually in the impulse phase of this price leg. So just because I want price to come here does not mean it's going to come here. This is just, I'm already identifying the inefficient pricing that I see generated inside of the impulse phase of this price leg. So if price is to continue higher to take out this high and then begin the pullback phase, I know this is the area of interest that I am looking for. So as of right now, though, I'm kind of sitting on the sidelines, just watching things happen. Like I said previously, I rarely enter trades during the impulse phase of the market, unless I got in based off of this liquidity draw here, which I should have, but that's on me. I was like, I could have been catching this entire move, but I missed it, so now I'm just sitting on the sidelines. I don't really want to chase the trades, which is what I see happens when I enter in on the impulse port of the trade, and that's ironically why I see it as impulse, because if I'm entering on the impulse, it's impulsive because I don't know when the pullback's going to occur. I don't know where, or I'm not tracking where the inefficiencies are, and I don't know when it's going to be mitigated. So I'd rather wait, which is what the models are built on. I'd rather wait for the solidification of the price leg and the pullback to know, hey, price has now generated that price leg, and we know it's likely to pull back to where the inefficiency was generated, specifically the origin of the move, in order to give valid responses, valid entries, valid trades. All right, so like I said before, the next price gap that we'd be looking for, if you're looking for counter trend opportunities, would be this price gap here. And then I still have this area of interest marked up here, but it's highly unlikely that price is going to come down here before, taking out the all-time high, which is also totally fine because, like I said before, I'm looking for a continuation and then pull back to mitigate and then continuation higher. So it just probably won't happen like within the week. But yeah, as far as the counter trend, if it were to play out this way, then we would get, potentially counter trend and pull back, but I'm not going to extrapolate too far. All right, so that's it for the NASDAQ. All right, on to gold. Like I discussed in the previous outlook, I said I wanted to see what the response was at this liquidity point internally of this price leg, existing from this structural point here to this liquidity point. We see that we have the impulse, once again, reiterating, pullback, and now we have the secondary impulse. And because we are, slowly moving higher, this is still part of the impulse. But at this liquidity point, it's very important to know that this is essentially a liquidity draw. So I would be expecting gold to actually pull back lower to mitigate whatever inefficiency was inside of this internal price leg, as of right now. And I'm not going to, deep dive into that because I'm going to leave that up to whoever's watching this to, frame up any entries or model, whatever you want to do. But based off of how I analyzed, I would see this right now as a liquidity draw. So that was an internal point if you're looking for, intraday or sort of intraday trades. But this right here, I would consider a liquidity draw. And now I would be expecting price to pull back to mitigate whatever inefficiency was generated, and then looking for continuation higher. Counter analysis, like I said before, is price can begin to move lower, and we would be expecting, if this were to break, the trend, that we would target this structural point here. But because our overall bias is bullish trend, I'm going to stick to looking for buys. I don't want to look for sells right now unless it's a short-term counter trend trade, which means that I'm not going to set my targets. If I were to take a trade to be the structural point, that would just be on the wrong side of the market. That would be counter trend essentially, right? And I don't want to get caught up in that anymore. So yeah, I believe that is every pair. Yeah, that's every pair. Okay, so that's it for the market outlook. If you have any questions, please let me know. Peace.